Hey everybody, welcome to my new channel. It is called Retire on Premiums. I have a couple things I want to get off my chest right away. So number one, I am not a financial advisor. I am not a professional investor. I am just a guy that likes to use what I think are some relatively simple stock option strategies to enhance the return on stocks that I like. I like to own. Number two, I'm documenting through this channel, hopefully over a very long period of time, an experiment that I am running of uh, comparing a high yield ETF called CONY or CONY from YieldMax to the return that I would be able to generate um, using what's called the wheel strategy, which the wheel strategy is a simple option strategy of cash secured puts and covered calls to generate premiums and income. I am, as I said, I'm not a financial advisor. I actually have a little bit of a financial background. I have an undergraduate degree in accounting. I have an MBA. I've worked in commercial lending and cash flow forecasting for large debt packages. I've worked in corporate finance in a software company. I've been a CEO of a company. I've worked at a venture capital firm, but I have no professional training in kind of options trading. And I'm really just here to document how I do. And believe me, you will see lots of mistakes that I make, and I'll call those mistakes out because I have a day job. Second thing is I am a huge fan of the channel called Retire on Dividends. If you haven't had a chance yet to watch the Retire on Dividends channel, um, he was my inspiration for this. Is that I love the content that he creates around the Yield Max and other high yield ETF products. But I thought it would be very interesting to do this experiment to compare if I am able to generate a yield similar, so yield instead of a dividend, it would be premiums. And then also if I'm able to either exceed or beat the total return, which looks at more than just the yield. It also looks at how the actual share price does. And so that's kind of my goal. So again, this first video is really just to introduce the channel. And I want to talk very briefly about why I'm doing this. And then in the next video, I will kind of give an update of where I am month to date, because I started this experiment at the beginning of the month. And my goal is to have this experiment run, for hopefully for months. And I can, because at any given month, I think it's, especially this month, if you know anything about Coinbase, in CONY, we know that this month had a major event in the middle of the month, which was the ETF decision by the Bitcoin ETF decision by the SEC. So very quickly, again, I just want to reiterate, not a professional investor, not a financial advisor, trade at your own risk. And let's get into just kind of my thoughts. So why am I doing this experiment? Well, number one, as I referenced, I am a CONY investor. I do own CONY and a couple other of the Yield Max ETFs. But I am also a shareholder of lots of other stocks that I use the wheel strategy on, which is essentially, sort of what uh, sort of what the Yield Max folks are doing without the cash secured puts. So when I thought this through, I thought, kind of what are the advantages and disadvantages of each approach? So, let's kind of talk about the advantages of CONY and then the wheel strategy as I see it, using the wheel strategy on a stock like Coin. So number one, I should probably say like Coinbase is actually not a stock that I feel super comfortable owning. It is so volatile and they lose money. And there are so many extrinsic and external factors that could impact their price, as we kind of saw this month. Fed monetary policy, um, SEC decisions around how they're treating cryptocurrencies, you name it. It's just so much on Coinbase. Now, that volatility is actually what drives the ability to generate super high dividends for CONY and high premiums in the coin in the wheel strategy. But it's actually out there beyond my kind of like super comfort level, but I decided to do this anyways. Said, what the hell? So let's talk about the advantages. CONY, super easy to purchase, right? You can make a decision to buy or sell very simply after you do your own due diligence and analysis. You don't have to understand, if you don't want to, the underlying mechanisms that the fund managers use to create that return that I think everybody's so enthralled with, right? Number two, super low cash requirement, capital requirements, right? You could buy just a couple of shares. So today the share price is, hovering somewhere around $20 or so. And so, you could get in for a couple $100. You could have a position, which is really nice. And then number three, you don't have to manage much. You're not the individual that has to, make the decisions on daily trades. And you don't even have to track it. You can just watch Retire on Dividends. He will tell you every day what the fund managers did the day before and his thoughts about whether they made the right call or the wrong call and what the risks are on a daily basis of, NAV erosion or, what he believes, the month to date payout is that's been generated so far. So on the wheel strategy, well, if you watch Retire on Dividends, you'll often hear him questioning where the fund managers are setting their strikes, right, on their synthetics and on their covered calls. So he's often thinks that they're not going far enough out of the money, or he doesn't agree with a decision they made. So if you do it yourself, you're making those calls, and I like that. Number two is, we've all become addicted to these monthly payouts of these high yield ETFs. What's really interesting, though, is that when you get into the wheel strategy, you get paid every week. And actually, you can get paid more than once a week. You can open up a position and then that day or the day later, close it, buy to close for maybe pennies on the dollar, and then open a new position and you get paid again. And so that's really attractive. And then finally, when you're using the wheel strategy, you're not using synthetic positions. I do have some concerns around, the fact that these ETFs are using only synthetic positions, meaning they are creating a synthetic long through a put call strategy that has an expiration to it. Where when you're using the wheel strategy, if you get put the shares and you are now a shareholder, you know, you can decide to stay a shareholder as long as you want. You can, sell calls that are way outside of the money, or even if they're in the money, you can roll a contract and you actually are the shareholder of those shares. And so there's some advantages in my mind to that. Let's talk quickly about the disadvantages of each, though. So CONY, one of the things that concerns me is that there's just this derivative position. There have been a couple ETFs over the last several years that have blown up. There was at least one, I think in 2020, that was a purely derivative structured ETF that was either shorting or going long the VIX. I can't remember. But there was massive volatility, lack of liquidity, probably a couple weird factors that happened, and that ETF literally went to zero. That kind of concerns me. I'm not saying that that's a possibility or a probability with any of the yield max or other ETFs, but in a severe market gyrations, black swan event, who knows what could happen to these ETFs, and that does kind of concern me a little bit. Next one is NAV erosion, right? I mean, through the nature of covered calls, you have a lot of downside risk, but when a stock moves, especially quickly upward, those covered calls are going to get called and assigned, and you don't participate in the upside. So over time, these shares of these ETFs will not track the full upside. So if a stock is just slowly moving up every week, these ETFs can work, but not really, because if that's the way that they trade, then there's not much volatility. And guess what? You don't have the premiums to be able to generate the high returns. And so the way that these high returns are generated is through these this volatility because that's what the premiums are tied to. And then finally, you kind of have a lack of visibility to the payout. Retire on Dividends does a great job of tracking what he believes the payout's going to be. But if you're not watching his videos, you really don't know. Where if you're doing the wheel strategy yourself, you know exactly what your payouts are. So what's the downside on the wheel strategy? Well, number one is you got to have 100 times whatever the share price is that you're doing the wheel strategy on. So as you're about to see in the next video, that meant that to do the wheel strategy starting at the beginning of this month at the put value that I picked for my first trade, I had to have 100 times $149 or $14,900 in my account. And that's a lot of money. Not everybody wants to allocate that to cash or has that amount of money to do a trade like this. Second of all, and you're going to see this risk in my next video, is that you run a real risk of being underwater on the shares that if you take assignment. So you'll see on the next video that I actually decided to take assignment on a put. I could have rolled the contract, but I decided not to just because I wanted to show the wheel strategy. And I'm underwater because the stock price has not gotten back to where I got put the shares. The volatility in a stock like Coin makes it very difficult to do this strategy because while it generates the high premiums, if you're not paying attention to it, it's very difficult to time your trades correctly. And as I said earlier, I'm not a professional investor. I have a day job. I have maybe 3 hours in a week to really dedicate to, kind of the option strategies I do, and that's on a number of positions. And so, you can sell a call and think you got a good price, and then 2 hours later or the next day, realize that if you just would have been more patient, you could have gotten twice what you got in some cases because the stock is so volatile. And then finally, what's the downside of something like Coin? Doing the wheel strategy on something like Coin is you got to put in the time. If you don't have 3 to 5 hours a week, plus all the time it takes to learn how to do this appropriately, you're not going to be successful. You're going to lose money. So again, in my next video, we're going to go through month to date, which I started this experiment on the 5th of January because that was the ex-dividend date for CONY. And I've been trading the wheel strategy since then. But again, just to close out, appreciate you being here. Positive shout out to Retire on Dividends as being the motivation for this content. And then look, trade at your own risk. This is not financial advice, but I hope you learned something and were entertained. Thanks a lot, and I will talk to you all later.